good to have you join us today. Hello and welcome to Business Daily. I'm Lee Ji-yoon in Seoul. Before we get started, let's first get a quick check of today's highlights. A recent op-ed in a UK newspaper suggests that Britain should look to Korea for solutions for growth in the post-Brexit era. With the U.S. expecting to see growth pick up in the coming quarters, we might also be looking at a Fed rate hike come September. These stories and more coming right up. But first, Korea's import volume index has seen a downturn last month for the first time in 3 months. According to a report released by the Bank of Korea, July's index tracking import volumes was down almost 5% from the same time last year. While inbound shipments of coal and petroleum products rose by roughly 9%, that of automobiles, which take up a large proportion of the country's total imports, plunged by over 13%. The BOK says this is largely related to Volkswagen Korea's emissions scandal that led to a sales suspension. In terms of the country's net barter terms of trade, which indicates how much a country can import using its exports per unit, it improved from a year earlier by 0.4%, as import prices showed a bigger decline compared to export prices. It's been 2 months since Britain voted to leave the European Union, and there have been worries about both its short and long-term economic prospects ever since. But an op-ed in the Guardian newspaper says the UK can take heart from Korea's example. Our Woo Soo-young tells us more.
South Korea is the perfect model for post-vote Britain, according to Christian Spurrier, a journalist writing for the UK's Guardian newspaper. In an opinion article published Monday, Spurrier presents Korea as a beacon of hope that can quell pessimistic forecasts on the UK's economy. Spurrier lauds the country's rapid modernisation process, as well as its global standing today as an export-led high-tech skills-based economy that overcame various crises, such as the Asian financial crisis and the slowdown of US imports. Korea has a similar landmass and population to the UK, and according to recent data from the World Bank, is now the world's 11th largest economy. Amid fears that Britain's economy will fall behind after its divorce from the regional market, the article highlights the fact that Korea achieved its economic success without any major trading bloc and without direct access to natural resources of its own. Korea's success is first attributed to its investment in education, but the emphasis lies on its impressive track record in negotiating bilateral trade agreements with the world's major economies. Noting that the broad terms of the Korea-US agreement was wrapped up in 14 months, Spurrier says those who fear a long stretch of negotiations for the UK's trade deals can take heart. He also notes that Korea even struck up an FTA with the EU, calling it the most comprehensive and liberal free trade deal since NAFTA. However, some points of difference remain. While Korea is mostly a homogeneous nation, the UK is much more ethnically diverse. Though millions of British voters may see Brexit as a chance to recreate a monoculture, Spurrier says this is now unfeasible. He says the key challenge for Britain now is how to strike out on its own while remaining outward-facing. Woo Soo-young, Business Daily.
Meanwhile, Samsung Electronics is closing in on the world's top semiconductor maker, Intel, with a double-digit boost in sales in the second quarter. Data compiled by IC Insights showed that Samsung registered sales amounting to $10.3 billion in the April to June period, an 11% rise compared to its rival Intel, which posted a 1% quarterly contraction with sales of $12.9 billion. This is a marked improvement compared to Intel's 40% lead in the first quarter. Samsung was able to close the gap in the second quarter by shifting its focus from DRAM chips, widely used in PCs, to NAND memory chips used in smartphones and portable gadgets. The Korean tech giant is also preparing to launch a 64-layer 3D VNAND flash memory in the second half to speed ahead in the race. Now, restructuring is still underway in the country's shipbuilding sector, and workers who get paid by the day are the first ones feeling the effects of such restructuring efforts. Our Lee Ju-young has more.
It's been a struggle for Korea's labor market. The youth unemployment rate is still sky high, still above 10% in the second quarter, while the gender income gap is the widest among all OECD member countries. What's also emerging as a point of concern, though, is the fact that an increasing number of day laborers are losing their jobs. According to Statistics Korea, the number of day workers in the first quarter of this year was roughly 1.4 million, dipping to the lowest in 28 years. The figure increased slightly in the second quarter to 1.46 million, but compared to that of the same time last year, it was 185,000 lower. The trend is even more pronounced in the month of July. While the number of regular and temporary workers grew around the nation by roughly 3 and 1.3% respectively, that of day laborers dipped by almost 5% to 78,000. The statistics agency says this is largely due to the drastic restructuring in the shipbuilding industry, which employs a relatively high number of day laborers. In fact, Daewoo Shipbuilding and Marine Engineering, one of the big 3 shipbuilders in the country, only has about 10,000 regular employees out of its total staff pool of some 30,000. The rest are laborers hired by the day. The number of unemployed day workers, especially in the country's Gyeongsangnam-do province, where major shipyards are located, has surged 42% on year, reaching some 64,000 people, considered one of the highest figures in the country. Lee Ju-young, Business Daily.
Asian shares are mostly in wait-and-see mode, including Korea's Kospi, which, as you just saw, closed up just 0.4% after slipping yesterday on revived talks of a U.S. rate hike. Fed Chair Janet Yellen is scheduled to speak at a meeting of global policymakers in Jackson Hole, Wyoming on Friday. With that, is the U.S. Fed Reserve finally getting ready to pull the trigger? For more on this, Professor Yang Jun-suk from the Catholic University of Korea joins us in the studio today. So good to see you.
Happy to be here.
All right, so over the weekend, the Fed's Vice Chairman Stanley Fischer actually signaled that a rate hike within this year is still under consideration, saying that the U.S. economy is getting closer to the central bank's goals. Now, at this point, we're wondering, what are those goals?
Okay, well, most central banks pay a lot of attention to inflation. The United States Central Bank, the Federal Reserve System, or the Fed, they also pay a lot of attention to the inflation rate. But they actually, by law and by charter, have 2 goals that they're supposed to give relatively equal weight to, which is controlling prices, so controlling inflation rate, and maintaining full employment. Other countries do keep full employment in mind, but their primary goal is supposed to be controlling inflation, but the Fed, by law, is supposed to look at both.
All right.
Now, the goal that they have stated that they're looking for is 2% inflation rate. It can't be too higher than that, can't be too lower than that, and full employment, which doesn't have a technical definition, a single number that they concentrate on, but it's usually thought to be somewhere between 4.5 to 5%.
Okay. Now, I guess at this point we're wondering, how close is the U.S. economy to those targets then?
Okay, well, as far as the unemployment rate goes, you can argue that they're at target right now.
Okay.
For the last 3 months, their unemployment rate has been below 5%. But their inflation rate has been extraordinarily low still. It's about 0.8%, but the Vice Chairman Fischer just mentioned that if you exclude the very volatile food prices and energy prices from that and look at what they call the core inflation, that's very close to their target of 2.0%.
Okay.
And also, the Chairman Yellen, as well as some of the so-called Dove members of the Fed, have been worried that even though the unemployment rate is low, other supporting variables in employment and growth has been weak. For example, the labor participation rate has been low. That means a lot of people have given up looking for jobs. That has improved in the last couple of months.
All right.
More people are looking for jobs. And then even though we have low unemployment rate, or the U.S. has low unemployment rate, they have very low increases in wages.
Oh, okay.
And that also in the last couple of months has been shifting a little bit. So that's why everybody's saying there's a good chance now that the Fed will raise their rates. But they still have a relatively low growth rate as measured by GDP. So that's somewhat working against the picture here. And the international national picture is still not very good.
The question now is then, is a rate hike going to happen next month or in December or next year? I mean, because we're seeing mixed signals from Fed members. So what can we expect?
Okay, well, right now, the last time I looked yesterday, the betting pool was looking at 25% chance of raising the interest rate in September.
Okay.
My personal feeling is that if they do decide to raise it, it'll be in December because there's too many problems internationally, not just Brexit, but the Chinese slowdown and possibly some problems in Italian banks and so on. And we have a very contentious presidential election in November. There's 3 chances of them raising the interest rate, September, November, and December, but the November meeting comes about a week to 10 days before the election.
Okay.
And I don't think they're going to raise it then because it'll have too many political consequences. I think it's more likely that they'll raise it in December unless the data keeps looking very, very good for September.
Okay.
But again, if you just look at the unemployment figures, then they're at the level where they can probably raise the rates right now. And I think that's why everybody's anticipating that perhaps it'll be in September.
Then do you think we'll get more clarity on the pace of future rate increases at the Jackson Hole meeting this Friday?
Typically, they do announce some policy implications then. Jackson Hole, Wyoming is actually a resort, and the Federal Reserve Bank of Kansas City, which is one of the Federal Reserve System banks, they host a symposium every year, and it's actually closer to an academic seminar than a government meeting. You have not only the Fed officials, but central bank officials from other countries. You have Wall Street economists, and you have academics who meet and talk about not only the current monetary policy issues, but also theoretical issues that academics have been interested in for last year or so. And the Chairman Yellen has said that she will make a speech there. And sometimes if Fed wants to communicate something, then they use this speech as one of the methods to get that point across. So everybody's waiting to see what Chairman Yellen thinks.
Now, I know that some experts are actually calling for adopting new standards when it comes to deciding on rate hikes. Can you tell us more about this?
Okay, well, if you're interested in monetary policy and macroeconomic academics, then this is actually quite exciting. What people think is that we've gone sort of a large structural change in macroeconomics. We used to say that 2% goal is a good goal for advanced countries in inflation rate. So inflation rate should be around 2%. But now they're saying, well, maybe it should be 4% because we need more room to reduce inflation, reduce the interest rate if we go into a recession. Along with that, there's something called a natural rate of interest or neutral rate of interest, what the interest rate should be at when there's nothing really wrong with the economy. And that usually was thought to be about 2% above the inflation rate. So we were thinking about 4% interest rate. But now they think that that natural rate has fallen to say about 1% range. So if we still keep the 2% inflation goal, that means the natural rate of interest should be at 3%. But now if we get into another global recession like this, that 3% may not be enough to spark the economy before going into zero rate. Now, some of the countries right now have gone into negative rates, but we don't think that's as effective. So we want to give some extra room for monetary policy to reduce the interest rate. So they're saying, let's raise the target inflation rate to 4%, and that's going to be a big change. But we have to still get out of the current slowdown first before we can raise it to that level.
There are also concerns that if the U.S. doesn't raise rates soon, then it will end up walking down the same path as Japan. As we know, Japan's interest rates have stayed near zero during the past 20 years. So what are your thoughts on this?
Okay, well, I think there's a fundamental difference between Japan and the United States. When Japan went to zero rates, most of the other countries, especially advanced countries, are still at positive rates. And they're they've lost about 20 years growth. The United States may have lost at best maybe about 10%, 10 years worth of growth. Even then, they recovered actually fairly early. They're not at negative growth or zero growth, they're just at very slow growth. And also, in Japan, they were the only countries who went to zero rates, but now virtually all of the advanced economies are at zero or negative rates.
Right.
So I think there's some fundamental differences between what happened in Japan and what happened in the United States. So I think it's much too early to draw the conclusion that the United States is going down the same path as Japan, but we'll have to see. Right now, what we can say is that Japan has really seen no room to raise its rates for last 5-7 years or so, but the United States, they're actually contemplating raising the rates, and they have good arguments to do so.
Now, if the Fed decides to raise rates in September, then what do you think the impact will be on the Korean economy and the global economy?
Okay, well, usually what we worry about is whether there will be a very quick capital outflow from Korea, like we had in 97 Asian financial crisis. I don't think that'll happen, especially since the S&P's ratings has gone up, and I think it'll only be about 0.25%. But there will probably be some capital outflow. That means some problems in Korean stock markets, depreciation of the won. Some people are actually looking forward to the depreciation of the won because they think it'll help the export sector.
Right.
But right now, I think the bigger problem is lack of global demand. So even though it may help us a little bit having that depreciation, I don't think it'll help us that much. But also, there might be some counterintuitive effects. If the United States raises the interest rate, that means the Fed is very confident about the growth path of the United States, and that may somewhat weirdly actually give more confidence to global investors as well as global economic players, saying that, well, Fed is confident enough to raise the rate, so we're definitely on a path to recovery.
Well, for now, I guess we'll keep an eye on that Jackson Hole meeting and what comes out of there, I guess.
Yes.
Thank you so much for coming in today.
Thank you.
And that wraps it up for today. Thanks for watching, and we'll be back tomorrow with more at the same time, same place for your Business Daily. Until then, goodbye.